Hello, everybody. Kirk Spano, and it is Monday, May 20th, 2024, as we record. Going to cover retirement income options May expiration update and stocks of the week, which is a little bit late, but going to cover clean energy stocks this week again in context of the conference I was just at, and then also energy stocks next week, which we'll touch upon a little bit this week too. So first off, retirement income options May expiration update. I'm about halfway through it. I'm almost done with the part that I want to really get to you, and then I will finish the rest as well. So let's cover a few things. The main points, the bullet points. The S&P 500 is still priced pretty strongly, although there is a bit of upside momentum left. I do think it is set up between the overbought and overvalued signals that there are a lot of covered call trades that you can make or some trimming that you could do, and we'll cover that in a second. The best valuation and growth opportunities remain in the small and mid caps, and many Russell 2000 stocks are not only many Russell 2000 stocks are not only undervalued by a lot, but they're also oversold. Generally, when something is undervalued and oversold, pretty good time to buy it or at least sell cash secured puts. So option selling ideas to look for this week. I'm going to cover each of the various subsegments, and I want to get the international list done because I think there's some international stocks that we want to take a look at. So in the grandpa stocks, a lot of these are pretty highly priced. Most folks won't have more than 100 shares of most of these. If you do, you can sell some covered calls, but I would do it in consideration of approaching these prices, which some of them are there, some of them are not. Microsoft, I think you'd want to trim it up around 480, so forth and so on for all of these. You can take a look at the charts. Here are the ones that I think you should trim now. Meta, it is double topping, so if you own Meta, I'd really be taking a lot of my profits right now. I think I'd probably sell 2/3 of the position, if not more. ServiceNow is at the end of a wave 5, so you probably want to do the same thing there. Sell around 2/3 of your position. Autodesk, Accenture, not quite there yet. Adobe, I would trim it now. I might even sell out of it. It's in a pretty confirmed downtrend, and I think Adobe, you could really see it get beat up pretty badly here. Cisco, August put. This is not even close yet. We can take a look at that. Cisco is in a bit of a downtrend, but it is pretty range bound the last couple of years, so it's hard to know if it really gets way down here. I don't think that it does, not with that balance sheet, but I don't think there's a lot of really strong upside just yet. I do think it does get up to here eventually. I just don't know if it's this year. Just not too in love with Cisco. If you know it inside and out and you understand all of its catalysts, you can trade it. I don't really think there's a huge secular growth story here. I think there's a lot of competition developing. Again, it seems to be the case every time that they become a leader, the rest of the companies catch up pretty quick. They're not the oligarchist that they used to be. So that's probably why, they had their big growth long ago, came down, and then finally got back there. But take a look at this. Over 20 some odd years, they basically, if you were one of those people who just bought it and held it, after 20 some odd years, you're back to where you started. So not a super sexy story that I can find. In fact, if it wasn't for the balance sheet, I don't know that I'd have them on the grandpa stocks list. I do think they have some downside here. This is your fair value gap where it should hold, but the overshoots could be down here. So I'm not real excited. I would sell the $40 put for $4 if it comes to me, but I'm not so sure that it will. Arista Networks, I would trim that now, again, up to 2/3 of the position, if not all of it. It's at the end of a wave 5. Agilent, medical technology. I do like this company, but it's not terribly close. Bristol Myers, I think you can buy that stock right now, and you can sell the $45 July put for $2. You'll hit it on the wiggle. It's not right at $2 yet. It's like $1 or something. But I do think you get a down day, it triggers. You just do a set it and forget it, good till cancel order. Chevron, I do want to show you Chevron. So This is a Warren Buffett stock. He trimmed it just a little bit. But based on what I heard at the Hart Energy Conference, I think it's going to break out of this range to the upside. So if you're in love with the idea of having an oil major that's American, I think you'd probably do all right here. It's not super duper sexy, but they do have a nice big dividend, 4%. I am more of an XLE person in the asset allocation. I think I'd probably be more interested in, there will be an ETF section in this article. I think I'd be more interested in buying the dips on XLE because you get a basket, pretty good companies without the single stock risk, right? So you get Exxon, Chevron, Conoco, EOG, huge producers. They're all near the top in the Permian. Get a couple other companies midstream. But when you go through this, you get the rest of the E&Ps as well. You get a lot of these names. If you want to stick strictly with E&Ps, the producers, this is the fund you want to use. I like a little bit more diversification, but this is a pretty good fund too. It doesn't get the interest anymore that it used to. I mean, the assets on this used to be way higher than 3 billion. I think that you're probably going to see this breakout. I can see it probably doubling in the next 3, 4, 5 years. Pays a decent little dividend, a little bit better than the S&P 500. To me, these dirty energy stocks are really trading vehicles over the next few years. And in particular, I like them as a hedge against the war in the Middle East getting worse, or Russia being emboldened to go even harder into the Ukraine. So I think energy is the hedge. Remember when President Trump was president, he wanted to keep energy prices down because he wanted to get reelected. Did not work. I don't think he's going to be as diligent with holding energy prices down, especially since he basically asked the energy industry for $1 billion to campaign. I mean, in return for him doing what they wanted. So I have a hard time understanding how people don't get that. That he basically publicly asked for a bribe and a quid pro quo. But if he wins, I think that is a recipe in the face of an oligopoly that's already been developing. We talked about this on Saturday. It used to be that 6% of U.S. production was in the hands of Exxon and Chevron. Now it's 27%. And it used to be that there were hundreds and hundreds of more pretty significant companies and then thousands of teeny tiny companies. And they've been all getting absorbed. And we're getting to a point where we may only have a dozen significant oil and gas producers in 5 years, maybe 20 on the tops. That's just a recipe in the face of peak oil production for much higher gas and oil prices several years out, especially if the EVs are talked into a slow adoption by those who want there to be a slow adoption. I mean, there's narratives out there. So for me, these energy stocks, these dirty energy stocks, they call, the industry is calling natural gas clean energy, which is funny because it's not. It's just less dirty than coal. I think this is probably the hedge, right? You can hedge a number of different ways. You can buy some 5-year bonds because the Fed will lower rates at some point this year. But I think the hedge with big upside are these energy stocks. I just think that this is where the biggest supply and demand disruptions could happen quickly over the next 2 or 3 years, and in particular even this summer. I mean, if we get dragged into a Middle Eastern war that's broader than what's already going on, which is not unheard of, then these are the stocks that could really take off. So what I was working on this morning, and I apologize for not working on it this weekend very much. I was tired when I got back on Saturday night. And yesterday, I just didn't do a lot. Going through the REITs. And I'm not one of those people that pound the table on REITs all the time. So throughout this huge downturn in REITs the last couple of years, you still have all these people who have REIT tip sheets that just says, always buy REITs, always buy REITs, always buy REITs, even though, with the exception of the industrial and storage REITs, none of the other REITs have beaten the market, right? None of the subsegments of the REITs have beaten the market other than industrial, storage, and then various specialty REITs like American Tower. So the reality is that REITs don't beat the S&P 500 except for a handful of subsegments, and that's where I'm looking. So I'm taking a look at Essential Properties Trust. There's not really a good option market, so I'm just going to buy it around 25. Innovative Industrial, we bought that in the 80s and 90s. I think you can buy the dips. Their ex-dividend date is right after the June option expiration. So I think that you can sell the June puts, the 110s, for $3, get a little bit of income until then. And then if the stock pulls back, you get the stock put to you too. I do think it's something that you buy the dips on, though. There's not a lot of downside in Innovative Industrial. I mean, this is really the big correction. It bottomed here. Target that they're showing is 150, but I like this price zone up here. This is called the fair value gap. I think that these yellow strands are usually pretty indicative of where you'll go over a slightly extended period of time. This is the magnet. Right in here is the magnet for price. So I think you're going to see Innovative Industrial in the next few years up around 200. Does it break out from there? Hard to know, right? There's a scale. They're only going to be able to get so big unless they expand into other types of greenhousing or other types of real estate. I think of this company a lot like I do Marathon Digital. How can that be? Well, Marathon Digital has a core business that is allowing them to get into other businesses. And I think that Innovative Industrial is going to follow that path. I think that the cannabis is going to be fabulously profitable for them over time. And that cash flow, because they have a great balance sheet for a REIT, that balance sheet is going to allow them to expand into other types of real estate. Now, do they do a separate REIT as they expand outside of the cannabis? Or do they start to bring it all in and create a diversified REIT? I don't know. But I do think that there are opportunities for them. The other opportunity is they just throw off a ton of cash, and that's fine too. So buy the dips on Innovative. They will eventually get more good cannabis news with being allowed into the financial system more fully. You did see, cannabis pretty much decriminalized across the board recently. So that's pretty positive. I just don't see this one not running to 150 in the shorter term, and in the intermediate term up towards to around 200. And along the way, you're getting a big dividend. American Tower, same deal. If you want to beat the ex-dividend date, if the stock falls a little bit, you probably sell the June 180 for $2. It's not there yet, right? Stock price is near 193. So in the next few weeks, you need to see the stock price drop. And I think you probably will. Now, it might drop way down here into the 160s. So I don't know that I would set a good till cancel order. I'm not going to, but I am going to watch it because this price right here, about 165, does seem like a pretty good price range because I don't think it's going to get down here again. I think that was the end. So it's just a matter of 1, 2, 3, 4, do a fifth wave down. I think so. Or 1, 2, 3, it already did. And this is the start of the uptrend. So you never know until after the fact. But, I think you can buy it in here. And then if it gets down to here, you buy more. So all of these will fall into the same category. Stag Industrial, First Industrial Real Estate, First Industrial Realty. Similar, not the same. But if you take a look at what they actually do and where they do it, First Industrial, where they do it, it's pretty important. Two more energy companies, Permian Resources and Coterra Energy. They really presented well. They didn't present themselves, but the private equity guys talked about them and showed different charts and graphs that Permian Resources and Coterra are in pretty good shape. Both companies are very likely to go through a merger at some point. There's not a lot of takeovers left to be done of the mid-sized companies. The mid-sized companies probably merge, and then what's left of the very small companies just get bolted on and bought up over time. But Permian Resources and Coterra, if they merge with somebody, maybe each other, maybe Devon, maybe Apache, all those companies in the mid-range on the E&Ps, you're going to see 2, 3, 4 mergers, I would think, in the next year or two, but we'll see. Newmont Mining, I think we should be pretty much ready to take profits on Newmont. I think that the gold rally is about to stall out. I think that what you've seen is on anticipation of the rate cuts and because China has really been buying a lot of gold. So this rally from low 30s to mid 40s, that 25-30% gain, looks like maybe it's got a little bit more upside, but I'm not so sure that we see a breakout all the way to 60. We could, but for my money, I think I'm probably selling a $50 covered call. Take a look at what that looks like. Build our covered call strategy. Whoops, say August, maybe. We did August $50 covered call, did $1.18. So I think I would let that get to, when this gets to about 47, 48 is when you want it to trigger. So imagine getting about $5 on the August 50. I think that you're going to get a little bit more run on the stock. I think that'll hit. You'd have an average gain if it gets called away from you at 50 of $55, right? 5 plus 50. So it's not there yet. Stock needs to rise a few more bucks, but I think the August 50 is the target, because even 60 I think is probably high end. So as it gets to this fair value gap, that's when you want to sell your covered call. If the stock pulls back, hey, then you still own the stock, still getting their little dividend. You've pulled out $5 of gains, and then if it does finally rally up here, you can re-rate the call all over. So that's how I think about that. If you just don't want the risk of gold and gold stocks coming down back to this range, then you should be trimming. But I do think you can let it rally a little further and then sell the covered call. Now, I don't want to go through the rest of the list. However, here's our high dividend stocks. A lot of these you can sell cash secured puts on. I mean, almost all of these. So I will have this filled in and I will send it out. All the growth stocks are below, and a lot of those you can sell cash secured puts on now too. In general, we really haven't gotten much of a correction just because we're at full employment. And it is weird to me that so many people just don't like this economy. I don't get it. I mean, I understand that the grocery store is more expensive. I shop 2 or 3 times a week. I keep an eye on prices. You know what was expensive to me the other day was mayonnaise. Mayonnaise is easily doubled in price the last 5 years. It was $7.99 for a jar of mayonnaise. I mean, I remember when it was $2.99. So I get that food expenses have gone up, but I will also point out the corporate profits. There was just a study out there. Corporate profits and taxes and inflation are all correlated. And these rise in margins at the companies, that's not AI yet, right? That's not AI yet. Since COVID, companies have really put their foot on the pedal of higher prices. They really have just been raising prices until, the consumer stops buying. And suddenly you're starting to see affluent people go to Walmart. I went to a Walmart recently. I never go to Walmart. I never, ever go to Walmart. And I went to Walmart for something because, it just costs so much at the Home Depot. And I was like, I can get this same thing at a Walmart. And sure enough, it was about 20% less. So I think that there is a comeuppance for a lot of companies that, to me, they've been gouging, and that's going to impact their margins or their revenues. What impacts their margins more, and Warren Buffett just talked about this, and I told you last year that this was going to happen. In the last year, I've repeated myself. When the Trump tax cuts expire, and they will unless he gets both houses, that's going to be bad for large cap margins. So I keep trying to see the logic behind the large cap rally. And the only thing that's there is full employment driving up SPY. So everything gets lifted. But when you start to have price discovery on a company to company basis, which happens in a slower economy, it gets to the point where you have to understand what you're doing. So right now we have a lot of amateurs in the market. We have for a while. That is partially the product of all the bailouts and then, we've been reshoring jobs and we're building infrastructure. Everything that President Biden has done has been about bringing home jobs and about creating good jobs. The knock-on has been inflation, and it really isn't monetarily driven. I know that the people who want to just chant that want to say it, but that's not where the correlation lies. Remember, money supply has been coming down for 2 years. So why is there inflation? It's not the money supply. That's been coming down for 2 years. So I think it is really a lot to do with parts of corporate America just seeing what they can squeeze out. And one of the complaints by a handful of people at the energy conference was that the Justice Department was slow walking the mergers to make sure that these companies didn't take advantage of people. And they don't like it. They want to say, the Biden administration vilifies energy, even though oil and gas production is the highest it's ever been. Hey, they vilify us. Hey, they let us do whatever we want. I mean, those two ideas just don't, make a lot of Vulcan logic there. So I really think that we should try to think through the inflation that's left and the price levels that we're at now. You almost have to see them flatten out dramatically in the next 6 months to a year. And I don't think that matters who the president is, unless we get an energy surge. If the price of energy suddenly goes up, we got big trouble. So anybody who doesn't support an all of the above energy strategy is out of their mind. The United States simply doesn't have the oil and gas to not do all the alternatives as well. So we will see how that shakes out in the next year or two. You know what I think about that. I think that we have a spike and a crash if it's Trump winning. And I think that if Biden wins, we chop through with a little bit of up, a little bit of down, but we get through it. The second half of this decade is just going to be a lot harder than the first half. And we had COVID in the first half. So we'll see how it goes. I do think the small companies still have the best value. And as money rotates, especially large cap money that gets sold out because of the pensions, and because as large caps become a laggard, people slowly rotate into the other assets. But right now, you're seeing guys like me and private equity who are smarter than a retail by a long shot, rotating into the smaller assets, the longer term time frame assets, the things that they can buy at 60, 70, 80, 90% discounts to what they expect fair value based on earnings and revenues and margins to be several years out. So if you're looking year to year and you're trying to trade, I guess that's one way to do it. But most people fall prey to the narratives and don't interpret them correctly. And the longer term, more patient investors, the ones that are looking 3, 4, 5 years out, tend to beat them. Historically, this has been true over and over and over again. So I don't know. I think that there is something coming. And I actually think the shape of the curves will be determined by who wins the election. The hugest risk is that if President Biden wins, the Chinese and the Russians and the Iranians become emboldened. If that happens, then there's permanent damage done to global geopolitics and the United States. So we'll see. I talked to a friend of mine who used to play baseball with me or for me, and back during the financial crisis, about half the guys were laid off, and they said, I don't have the money to play baseball. And I paid for everything because I was already doing well back. I don't share with many people. I mean, I share with you sometimes how I'm doing financially, but this guy is making more money than he's ever made, and he has nothing but complaints. And the shit that came out of his mouth the other day, what he was talking about kind of blew my mind. So I don't know if Joe Biden can make the arguments that I would make. I just don't know if he's dynamic enough anymore. However, his policies are everything that everybody asked for, and the narratives make it seem like it's not. So I'm really trying to figure out how this plays out. I am more conflicted now than I have been in a while because I have seen the polls on black voters and younger voters, and I think there's just enough people buying into things that really aren't good for them that Trump might win. And if that happens, I'm going to make a ton of money, but it's not going to be good for most of the country. I try to explain that to people who aren't very sophisticated financially. And then they always pivot towards, but I vote for these other things. I vote for, or I vote for this, or I vote for that. It's just all these fringe things that don't affect many people very often. And suddenly they're core issues when they never were before because they want to rationalize what they plan to do in November. It's confusing to me. But it affects this because if we disrupt ourselves financially around the globe because we back away in the wrong spots and we allow energy to get expensive because we don't embrace alternative energy in the face of flattening growth in oil and gas, with oil probably peaking this decade for our production, unless we drill the hell out of the Gulf of Mexico, and it takes years to get those projects online. We really run the risk of falling behind on energy if we don't do the all the above strategy. I don't think people understand how cataclysmic they don't get it. They don't get it. And it's important to tell a kid who's going to vote for the first time, look, man, if you want to lose Social Security and Medicare, And if you want energy to be real expensive, then go ahead and vote for Trump and this batch of Republicans, which honestly, if I were the Democratic Party, I would start primarying Trump Congress people with blue dog Democrats that used to be Republican. I really would. I'd provide that alternative because I think that that's how you broaden out the Democratic tent. I think that's how you get some balance to the force, and we'll see. But so many vested interests and so many people playing power politics versus doing what's right. So many people confused in the population between social media and just buying into stuff that's just not true. That I don't know. So my plan is I'll speak my piece over and over again until there's a conclusion in November, and then I will adjust my portfolio accordingly pretty quickly. But I will tell you that the first thing I'm doing right now is I'm buying real estate and energy because Trump's a real estate guy and the whole tax code favors real estate. And if interest rates come down, real estate does well, and then energy goes up. I mean, you get a huge. I mean, you could see certain asset prices go to the moon. You really could. Energy, real estate, and then who would take it on the head? Clean energy would probably take it on the head if he finds a way to pull subsidies. Tech could get beat up again, which would be horrible. So we'll see. We'll see which way the curves curve. I mean, I think we probably end up in the same spot in 10 years. It's just a matter of, do we get there in a more peaceful, orderly fashion, or do we just bash our heads against the wall until we get tired of it? I'm not sure. But like I said, the big issue that the CIA guy brought up at the conference was that Trump really could destroy things for us geopolitically and globally and financially. And that, tell you what, that is pretty frightening. It would take a long time to repair that. Take a very long time to repair that. So in the meantime, I think you hedge with real estate and energy. We see what happens. Next week, stocks of the week will be energy stocks. I did talk about a few of them today, and I will put these. You'll find these in the chat room. So at Margin of Safety, there's a separate chat now. So just like at Fundamental Trends, I have multiple chat rooms. I added Mosey Moore. So investing context, financial planning, science, tech, policy, life, sports, poker. That's what this chat room is for. The main chat room is if you want to talk about specific stocks and ETFs, or ask me questions or put direct links, right? I mean, I don't need the macro links here. If you want to specifically talk about a company or say, hey, XYZ company did this, go ahead and post that here. Or ask me questions. And Teresa too. So she just put something up about Heron Therapeutics. Looks like it might be breaking out. Yeah, if it gets up to this 10 to 12 range, which I think is viable too, then we'll have to figure out if we take some profit. All right. And then the Mosey videos are in here, view only. And then because I just don't want to have questions and answers in a lot of spots. So ask the questions in the main chat, except for the options. The options, go ahead and ask option-specific questions here. All right. Have a good day. And yeah, I came away from this conference with a lot more concerns than I had before I went. All right, everybody. Take care.